Power and corruption are two sides of a wicked coin. Welcome to the podcast that tells stories of the world's largest, most salacious corruption scandals and explores the myriad ways corruption creeps into the hearts and minds of men and women, the consequences of corruption for perpetrators and victims, and the red flags that, had they been identified and addressed, might have changed the course of history. I'm Diana Shaw, and I'm joined today by my co-host,
Tatiana Sainati.
We are lawyers at the DC-based law firm Wiley Ryan. I'm a partner in our white-collar crimes practice, and Tatiana is the head of our International Arbitration and Disputes Group. Welcome back to our second season. As those of you who joined us for the first episode know, we have a new format this season, and we will be joined by a special guest each episode. Today, it is my pleasure to welcome Ira Mirsky to the show. In addition to being a dedicated Wicked Coin listener, Ira is a special counsel in Wiley's corporate practice where he handles a range of tax, financial reporting, and business planning matters. He has nearly 30 years of tax and corporate governance advisory experience in roles with global accounting and law firms, including specific expertise in the tax, financial statement, and Securities and Exchange Commission, or SEC, disclosure rules for employee benefits and executive compensation arrangements. During his tenure at one of the Big Four accounting firms, he served as one of the principal liaisons between the firm's tax and audit practices concerning the resolution of some of the country's largest stock option backdating cases, including the particularly notorious case, which is the subject of today's episode. So there really isn't a better person situated to help us unravel the complexities of today's scandal. So thank you so much for being here, Ira.
Thanks. I'm excited to be here. Longtime listener, first-time caller.
Love it. Thank God you're here because I have a pretty superficial understanding of these things, so we will be leaning heavily on you to unpack all that went wrong. All right, let's get into this story, which is super bizarre and super juicy. It's what I would characterize as one part Wall Street hustle, one part international manhunt, and one part bar mitzvah in the Namibian desert. Quite a combo. Yeah, for real.
That's where I think of when I think of a bar mitzvah venue.
Yeah, totally. Okay, so let's rewind to the 1990s. Comverse Technology, not to be confused with the shoe company, Comverse Technology, was a rising star in the telecom world. If you had voicemail on your cell phone, back in the day, there's a good chance Comverse had a hand in it. They were pioneers in voicemail systems, text messaging platforms, and call answering services, basically all the plumbing that made the mobile world work. And at the helm was this guy named Jacob. He went by Kobi Alexander, so we'll be referring to him as Kobi. He was born in Israel, trained as an engineer. He had the charisma of a salesman and the sharp edge of a deal maker. Ooh. His employees liked him, investors adored him, and Wall Street analysts just couldn't get enough of him. And he looked like the perfect guy to lead a scrappy tech company into the internet age. Now, back then, the way to lure talent wasn't always about huge salaries. Tech firms had a different weapon: stock options. So this is where you get paid partly in options, which are, and you can correct me if I'm wrong, Ira, valued at today's stock prices. And if the stock goes up, you're basically sitting on a jackpot. Okay. So you get in early, and then if the company does well, you're a bazillionaire. But here's the rub. So obviously, stock prices bounce around every day. Sometimes they're very high, sometimes they're low. So imagine if you could just, rewind the tape and pick the day to grant yourself the options when the stock price was at rock bottom. I mean, that's not actually the day you acquired them, but you kind of fudged the paperwork to make it look like you did. And then suddenly those options could be worth way more when you finally go to cash them in. So that, in a nutshell, is stock option backdating.
So is it when you go to cash in the options, basically what you're doing is simultaneously buying them at whatever price you've now listed on the backdated, and then you're selling them at the...
So stock options are fantastic for entrepreneurial companies, especially if they're light on cash reserves, right? Mm-hmm. Because it gives the ability to give an executive or a candidate the opportunity to wait and see and lock in at a stock price. But under the financial accounting rules in the day, you had a provision that basically said if you grant the options with a strike price equal to fair market value on the date of grant, then for book purposes, you never have a compensation expense charge. Where by comparison, if you grant options at a discount, so then they're what's called in the money because there's already a inherent value, then you have much less favorable accounting with an expense hit. And so there was an incredible amount of temptation to manipulate the grant date so that you could get to real value, but not be entirely transparent to shareholders. And so ultimately you have accounting issues, you have SEC issues, and a whole lot of potential civil and criminal exposure on the back end if you get caught. But it's so complex that there were maybe 140 plus cases that were brought and likely hundreds more that were just never able to be proven.
Got it.
And this is what we'll see. So when companies did it secretly, hiding the real timing from shareholders and regulators, that's when it crossed the line into fraud. Okay, so at Comverse, the SEC later alleged that Kobi and his lieutenants got really good at this game. They weren't just like occasionally picking lucky dates. They were systematically combing through the stock charts and picking the lowest price days, sometimes weeks or months after the fact. And the result was that executives and favored employees got these sweetheart deals. On paper, it looked like just genius timing. And as you said, it was kind of tricky to figure out. But in reality, it was just cooking the books. The company's expenses were understated as a result. Profits looked higher, and investors were none the wiser. And it wasn't a little slippage on the margins either. Comverse allegedly handed out hundreds of backdated grants worth tens of millions of dollars. So it wasn't just sloppy paperwork. It was a whole shadow compensation system, essentially. Now, the next part of the story I love. Tatiana, who are the typical heroes in our scandals? The ones who uncover the schemes and the bad actors?
I mean, it's usually the press.
Right? Investigative journalists, maybe government agents or investigators, maybe a whistleblower every once in a while.
Intrepid employee.
Okay. Well, in today's story, it's a completely unlikely character. It's a professor doing academic research.
Stop.
Yes. I love it. Okay. So a guy named Eric Lai. You can't make it up.
No, you can't
L-I-E. Eric Lai. A finance professor at the University of Iowa, which was featured in last episode, wasn't setting out to bust anyone. He was doing what professors do. He was crunching data and publishing papers. And in 2004, he studied thousands of stock option grants across corporate America. And what he found was bizarre. Statistically, companies seemed to have supernatural luck. Over and over, they granted options at prices that just happened to be the lowest point of the month, sometimes the year. And like clockwork, the stock price would jump right after the grants. And so he didn't accuse anyone directly. He just laid out the math in the paper and said essentially that the odds of this happening by chance were basically zero. Now, his paper was, as these papers are, very dry, very academic, the kind of thing that typically you would expect like maybe 12 people to read. But in this case, guess who read it? The regulators and the press. So they were very interested, and suddenly people started asking, wait a minute, is this evidence of companies actually cheating? So that study essentially lit the fuse, and Comverse was one of the biggest explosions.
So the article was a 2005 publication in the Financial Management Journal. In March of 2006, the Wall Street Journal broke the story. And just to really put a point on it, for 2007, Professor Lai was named by Time magazine as one of the 100 most influential people.
Oh, my God. That's quite an accolade.
Seriously, probably not what he expected at all when he published that paper.
Yeah, stepping out of obscurity. Wow. So by the mid-2000s, regulators are circling. An internal review at Comverse confirmed the worst. Years of backdating, hundreds of suspect grants. And in 2006, U.S. prosecutors charged Kobi Alexander with securities fraud, conspiracy, and making false filings with the SEC. The allegations painted him not just as a participant, but really as the chief architect of one of the most elaborate backdating schemes of the era. And now, this is the part where a normal CEO calls a lawyer, probably holds a press conference, maybe even expresses some version of, I look forward to clearing my name. That's certainly how I would be counseling my CEO client. But our friend Kobi Alexander, no, he had other plans. In the summer of 2006, as indictments loomed, but totally unrelated to the indictments, I'm sure, Kobi quietly slipped out of the United States with his wife and children. Now, if you were fleeing and you could go anywhere in the world, where would you go?
The Seychelles.
Oh.
Provided they don't have an extradition treaty, which I believe they do not.
Yeah, that's one of my chief criteria. Somewhere with no extradition treaty with the U.S. and preferably good restaurants. The Alexander's destination, not London, not Tel Aviv, not some offshore island. No, they flew to Namibia.
As one does.
As one does. Why Namibia, you might ask? A couple of reasons. First, at the time, Namibia had no extradition treaty with the U.S. Okay, that makes sense when you're facing up to 25 years in prison. Okay. Second, and this is where our man Kobi was really on his game, apparently he had been quietly transferring millions of dollars overseas, including into a Namibian bank account. So he already had a handy little financial safety net to draw on there.
I bet you can live quite nicely in Namibia on a few million dollars.
I think so. And third, Namibia is actually not a bad place to disappear. It's politically stable, it's beautiful, and it's far enough off the beaten track that you're not likely to run into a lot of Wall Street lawyers at the grocery store.
With the Namibia flight, what actually happened is dual citizen Israeli in June of 2006, they flew to Israel. In July of 2006, there was an agreement and a flight booked that he was supposed to be back at JFK. And he never showed up when they were there to meet him. And they searched for him and ultimately figured out he was in Namibia. And there was a great statement from his attorney in the United States, his defense attorney, because I was with an accounting firm at the time. My client simply chose to relocate his family to Namibia. He didn't, as you'll do, not chose to flee extradition.
No, of course not. Of course not. He sets up shop in Windhoek, which is the capital, buys a mansion, as one does, settles the family in. And then, if you're a local, you might just see this successful foreign investor with a lot of money to spend walking the streets. But if you were the FBI, you were watching a CEO turned fugitive, basically flipping you the bird from halfway across the world.
Living his best life.
Mm-hmm.
And he was at the top of their most wanted list.
Oh,
at
for
one
sure.
point.
Oh, for sure. And he did not keep a low profile in Namibia. In fact, not long after arriving, he decided to throw a party, a big party, for his 13-year-old son who was being bar mitzvahed. So what did he do? It wasn't just enough to throw a party, for his family, keep it small. No, he decided he needed to charter planes and fly dozens of friends and family from the U.S. and Israel for this party. Suddenly, Windhoek is hosting this surreal gathering of relatives, rabbis, and old business contacts, all for the bar mitzvah of a fugitive son. Wow.
So to put it to scale, they estimate that there were 100 Jews in Namibia before the bar mitzvah.
Okay.
And they flew in over 200 guests from the U.S. and Israel, including the rabbi.
Oh, my God.
For the bar mitzvah. The bar mitzvah was a 4-day-long celebration. And just to sort of poke the bear, apparently one of his son's childhood friends was not invited to the bar mitzvah because his mother was a federal prosecutor.
Oh, that's really driving the knife in.
Wow.
Well, prosecutors back in the U.S. were furious, just furious. I mean, you can imagine the optics, right? So a man charged with a massive fraud is out there hosting parties while investors back here are left holding the bag. And it's almost like this cinematic image, disgraced CEO living large in exile, celebrating in a country that, couldn't or wouldn't send him back. Now, Namibia was not totally blind to what was going on. The U.S. government did petition to get Kobi back anyway, treaty or no. And for years, he fought it in Namibian courts. His lawyers argued that basically he was being unfairly targeted and that he wouldn't get a fair trial in the U.S. Meanwhile, I'm sure completely unconnectedly, he was investing in local businesses, contributing to charity, even earning a reputation as a community benefactor. So certainly complicates the situation a little bit.
One of those examples was he invested almost $3 million in an 84-unit low-income housing complex.
So, yeah.
I mean, he thinks ahead.
He really does.
He had about $138 million in ill-gotten gains, so $3 million he could spare.
Yeah, he's a savvy guy. Back in America, the prosecutors are just seething. Shareholders saw Comverse's stock completely collapse, and then, eventually the company's once glittering reputation sank into scandal. And every time Kobi appeared in the press, smiling in Windhoek, attending community events, it only rubbed salt in the wound. And for nearly a decade, this cat and mouse game played out. The U.S. wanted him back. Namibia wasn't budging. And Kobi was living what looked like a pretty semi-normal life, even comfortable life in exile. But eventually, time has a way of grinding even the longest standoffs down. And in 2016, 10 years after fleeing, Kobi finally agreed to return to the U.S. voluntarily. By then, Comverse had been gutted by the scandal, broken apart and absorbed into other companies. So really, this was the time that the golden age of voicemail was kind of long gone. And facing the charges, Kobi struck a deal. He pled guilty to securities fraud. He agreed to forfeit millions, which it sounds like he had plenty to spare. And he was sentenced to 30 months in prison. So compared to the decades that he could have faced, it was basically a slap on the wrist.
I think he pled down from 35 criminal counts to 1.
Wow. I'm sure at that point they were just happy to get him on anything.
Yeah.
And I think he served less than a year of sentence in the United States, and then they cut a deal to let him finish his sentence in Israel because he was a dual citizen.
So yes, he got a slap on the wrist. Now, for a man who'd once been worth hundreds of millions of dollars, it's a dramatic fall, but still, in the grand scheme of things. Is he still
worth hundreds of millions of dollars?
Good question.
I don't know how much they ultimately got back, but he was supposed to disgorge $138 million.
Okay.
So, Ira, given your background, I imagine you've encountered many shenanigans like this across your career. One of the things that I struggled with the most, and maybe we'll just kick off the red flag roundup because I want to get right into it. This question about when backdating tips over into fraud. So it seems like backdating under some circumstances is acceptable. So can you kind of walk us through, is it illegal? When is it illegal? When is it not? How does it work?
So stock option backdating is kind of a spectrum. And at the one more benign and air quotes innocent side of the spectrum, it's I'm the CEO. I come down the hall and say, Diana, Tatiana, you're each doing a great job. We're going to grant you 10,000 options. But under the terms of the stock plan, we need to have unanimous vote of the board of directors in writing. And that doesn't happen for 2 months. Stock price is volatile. There's a 25-cent per share fluctuation. So now we've got a grant timing problem, even though both of you can fairly say, hey, there was a commitment to provide options on date X. Now, fast forward, and this is a very real example with one of the preeminent antivirus software companies. 25 cents was the flux in that case. 25 million was the spread when the core executives later went to exercise those options.
Yeah, that's a nice chunk of change.
So the financial statement restatement implications, the SEC implications get ugly. So to be clear, stock option backdating is not inherently illegal, but the requirements for it not to be illegal are rarely met. And the fundamental requirements are, number one, you've got to have transparency on your disclosure.
Right.
Number two, you can't violate shareholder-approved plans. And most stock option plans explicitly provide that the options cannot be granted at a discount below fair market value.
I see.
Okay. So in the hypo that you gave us where the CEO gives Diana and I 10,000 shares for the great job we're doing on date X, and it's not approved until date Y, that would have to be in the disclosure somewhere. But we are dating it this date because...
Correct. And so as far as the law and the accounting rules are concerned, you absolutely could grant in the money options, even deep in the money options, as long as you disclose it. It's just that the shareholders and the accountants are going to insist on appropriate recognition of the corresponding expense on the books.
I see.
And so that was the big reason that folks were engaging in the stock option backdating. And Comverse, in one sense, was unique because they not only engaged in conventional backdating, but they actually created a slush fund where they put backdated options in fictitious employee names so that later on, when they wanted to retain key employees or to attract new employees, they could give options that were already inherently in the money. Now, the layers of fraud that presents
kind of genius.
are
It is
compelling.
genius.
This was both Kobi and the then CFO were integrally involved in this slush fund scheme.
And let me ask you, the state of the law and accounting rules at that time, that was clearly illegal, or were they operating in some gray?
So what they were doing was clearly illegal.
Have the rules changed at all since this Wild West time of the mid-2000s?
So the rules have fundamentally changed. First and foremost is Sarbanes-Oxley that came in 2002. And Sarbanes-Oxley introduced what's referred to as the T+2 rule, which basically means you have to disclose options within 2 days of grant. And so that did two things. One is that it creates a clear notice that now anything that doesn't comply with that rule, you are violating Sarbanes-Oxley.
Yeah.
Second is that it now brought a practice into place. And so just to revisit our friend Professor Lai, he co-authored a more recent paper that, not surprisingly, showed an incredible decline in stock option backdating
Shocking.
after the implementation of Sarbanes-Oxley and these new compliance rules.
I'm sure that's entirely coincidental.
So that's Sarbanes-Oxley.
Okay.
Second is the financial accounting rules fundamentally changed for stock options. So instead of creating a rule that said if the options are granted at fair market value, there's no compensation expense, what the rules now say is we recognize that even if they are in fact granted at fair market value, there's an inherent value proposition because I can take a 10-year, if it's a 10-year term, wait and see without putting any money at risk to see what happens with a locked-in price. And so what that meant was that the ability to manipulate was dramatically changed.
Yeah.
You had disclosure with these now very complex analytical models because it's a fairly complex algorithm to say, well, what is this worth to just be able to sit on the sidelines and wait and see?
Right.
Right. Last but not least is you had a fundamental change to the tax rules. Okay, so under the pre-existing rules, you had rules that really affected the top 5 compensated executives, but as a result affected what the compensation scheme looked like for everybody, where the rules were a limitation on deduction. So you couldn't deduct more than $1 million of compensation to each of the top 5 compensated employees, but with an exception. If it was performance-based compensation, which includes stock options granted at fair market value, those were accepted from the rule.
Okay.
So this created another incentive. So in 2006, there were new rules brought into play for non-qualified deferred compensation arrangements, and this included a more expansive view of what is non-qualified deferred compensation, where Treasury said, we're smart enough to see that And a discounted stock option, which has an inherent value proposition on day one, is another form of non-qualified deferred compensation.
Right.
And so that meant that even for these still out there in the money options, you potentially had some bad tax consequences for the executives. And it also means that going forward, you now have a super robust valuation methodology for grants of stock options and the corresponding value. Again, we're talking here non-public companies because we don't have an available market price when the options are exercised. And these are referred to generically as a 409 Cap A valuation of the company.
It sounds like what these rules did is not necessarily make something illegal that had been legal, because if I'm understanding correctly, no, this was always illegal, but made it a lot easier for the government to look into the books and see what's actually happening.
Correct.
So it sounds like these changes, and I'm asking this as a question to you as the expert, these changes have made it harder to engage in this kind of conduct. Is that a fair statement?
Yes, that is a fair statement. But at the same time, when you understand the inherent complexity here, when you understand that in part at the root, when you're talking about a case like Comverse, there was fraud and deception. Right. It means that at the end of the day, what they've really learned, because it still happens, is how we can stay off radar. So
right.
Pigs get fat and hogs get slaughtered. We don't go for the lowest quarter or annual price, but we still pick an advantageous price. And so there is still gamesmanship going on, but the auditors, I'm talking about the financial auditors, now have a much more robust set of tools and a much more discriminating way to look at and think about stock compensation plans. And for most companies, especially public companies, they are super conscientious of the fact that you have all these watchdog groups that are now specifically looking at your stock option plan, looking at your trends, and, you know, with the technology, with the AI tools that are out there, and given the notoriety that Professor Lai was able to make for himself, there's a lot more financial academics that are also incentivized to take a look closely at what's happening.
This was going to be my follow-up question. So it looks like they came at it from one angle, which is to force a lot more transparency, which has its own sort of deterrent effect. But my other question then was, do we now have tools that make it much easier to potentially identify the fraudsters who are intentionally trying to get around these rules? I mean, Lai had to engage in what I assume was painstaking analysis, whereas now I would think with AI, they can do data analytics to maybe get at these guys who are trying to stay just under the radar. Is that the case, or is it still pretty hard to detect?
Unfortunately, the answer is it's still pretty hard to detect. I mean, there are trends and patterns that, you know, can give you the sense of, you know, walks like, quacks like a duck, but to prove it is challenging. And, you know, look no further than the Comverse Technology case to say that at the end of the day, with a guy who fled the country, when he came back, they still turned around and decided, we're going to go with trying one of the strongest of our 35 criminal counts. And, you know, still how much of the money they found. I mean, there was over 50 million that they traced to Israel, and I don't know how much of it they ever got back.
Wow.
You know, this kind of brings me back to our last episode, too, where you have a practice that is illegal, the underage sports betting, and also has some pretty serious collateral consequences. And all these people are just doing it anyway. And this seems, again, like you have a situation where a lot of people were in on this, knew it was wrong. Do we think it was just either, well, so many other people are doing it, it can't be that wrong? You fall victim to this mentality of it's not actually that bad. Who's actually getting victimized here? What's the real problem? Or we're not going to get caught because it's really hard to detect.
I think for sure there was a lot of we're not going to get caught. I think it's worth taking a step back to the $1 million compensation deduction limitation, because this is a provision that came in under the 1986 Act. And clearly when Congress wrote the law, they were looking at perceived outrageously compensated executives, and they thought they were setting a ceiling. Instead, it turned into executives seeing that as, well, that's kind of the floor because that's what I can get in conventional compensation. And then I can be creative
Beyond.
with all kinds of performance-based compensation outside of that $1 million limitation, which included the incentive to have their cake and eat it too of, can we grant stock options, avoid the adverse financial accounting, and still escape the deduction limitation?
It's like anytime you set up a system,
Yeah.
people will find a way to
That's
exploit
exactly
it.
what I was just thinking.
It all boils down to human nature and incentives.
And we're all feeling a little underpaid now with that $1 million.
Yes, we are.
My favorite irony in the compensation space is that we generally refer to that concept, because this is what the enforcement action is called, as reasonable compensation.
Reasonable. Gosh, what a subjective term in this space.
How jaded do you feel when you practice in this space to say, how is it that I no longer flinch at calling it reasonable compensation when we're talking about $1 million as the conventional compensation, and then everything else? And that's, of course, not counting airplanes and other perks and
Stock options.
Must be nice.
in fact, I've got a great story about airplanes for another session. So.
Ooh, we'll have to have you on again, Ira. Well, thank you so much for being here. You actually explained this in a way that my non-math brain sort of understands.
Yeah.
I will not be joining our tax group anytime soon, so fear not. I will not be invading your space. But you really did help us understand what happened here. And I feel like I could actually explain stock option backdating in a very rudimentary way to someone if they asked me. So I really appreciate you educating us. I also want to thank our listeners for joining us and invite you back next month for another Wicked Coin episode. We've got a great slate of scandals and guests for you this year, so get excited. Till then, if you like this podcast, please let us know by liking us on whatever listening platform you use, and maybe even sharing us with friends, family, and anyone you know who, like us, loves a good story about people behaving badly. As always, be good, and we'll see you next time.
Bye.
Bye.